All right. Good morning, everybody. We don't have the AM edition of the Founders Note yet, but we can see the rebound working out pretty much around the world. Asia really led that advance. Japan, no, down 3.2, 3.25. Hong Kong basically flat. Europe flat. Small caps, 0.25% with the Dow, and the S&P up 1, with the NASDAQ up 1. They were up more, gave it back a little bit at a key level. Right up against the ADR half red line. And the put wall has moved. So where we see this C2, that's the new put wall. Bring those numbers over. Yeah. So we faded down and bounced on the put wall. That kind of needs to hold today. We've seen last week what happens when we test the put wall and that put wall doesn't hold. $52.32 is the cog line. It's the put wall. It's also the halfback of yesterday. So triple support, it really needs to hold. There's just no other way to lay it out there. And when we look at what is on the table for today, there's no reason really that it shouldn't hold. We're not really going to see any really big common economic events: CPI, PPI, non-farm payrolls, QRA, FOMC. We don't have any of that. We do have some auctions today. These aren't the ones that are typically high impact, but whenever we have auctions during the day, you don't want to just dismiss them just because they're not one of the big ones. We're not out of the woods yet either. When we look at the VIX, these levels are from David Keller at Stock Charts. He laid these out a little while back, and they just make a really simple visual. We still need that VIX to come down. And most of the pundits and analysts out there are saying the market greatly overreacted for a variety of reasons. And most of the things that they overreacted to have already kind of been swept away, like the carry trade issue. We're back above key levels. One jobs report is nothing, right? We need more than one. And we got data yesterday that kind of backed up the idea that everything wasn't as bad as everybody thought. And the Fed did not run out and give any credence to cutting early, and certainly didn't acknowledge the idea that we heard over the last 4 days of a 75 basis point rate cut and 50 basis point rate cuts for September, because that would just be over exaggerated at this point. So things are normalizing a little bit. It doesn't mean we're out of the woods and that we should all just run out and buy a bunch of stuff, but things aren't as broken as it seems. So we're at the floor pivot. Turn these channels on. You can see today's channel is kind of narrow. It's not as narrow as I'd like it to be. Certainly more narrow than yesterday. The more narrow the channel, the more likely it is that a breakout sticks. These channels, of course, do not move price. They don't make breakouts work or make breakouts fail. They just give us an idea of what breakouts should do. It's very much like the spot gamma's gamma index, whether or not it's in positive or negative territory. Right now, it's still sitting at 3.314. That's what it was last night. We're still waiting on the AM edition to see if the spot gamma's gamma index has changed and moved back towards 0, which is the expectation. We're moving back towards that weekly pivot, which, like I said yesterday, is the base case argument when we open away from the pivot like we did, that we'll go back towards it. When you look back throughout history, the S&P doesn't spend a lot of time underneath of that weekly pivot. Even in bear markets, it doesn't spend a whole lot of time underneath that weekly pivot. So when we open quite a distance away from it, one of the biases is that we're going to go back to it. Of course, anything can happen. We can get stuck at a key level. 5,300 right now is that level. Can't seem to get past it. Waiting on data, but we don't have any data today coming out. We do have an MDP from yesterday. That's a missed daily pivot. It's 2 days in a row, Friday and yesterday, where we did not hit the pivot. If you don't know anything about that MDP, it's worth kind of at least understanding the concept. It's not mine. I didn't develop it. I don't trade it, but I certainly use it in my analysis. Just hit YouTube, type in something like missed daily pivots. You should find videos on it. But we're not as far away from that weekly pivot as we were, and that has set a low. We could expand farther away than that. We've seen when a level has been made on how far away from the weekly pivot we are, and then the market goes and challenges that level and goes even farther away. Say on a week like this, we were pretty far away, and it tried and tried and tried, and then finally it did go farther. It didn't work, it didn't stick, but it tried to go farther. It's certainly possible this week with the low that we have set and that distance from the weekly pivot. We could go farther than this low, but it would take something extra to do that. And right now there's nothing on the table that would give us that extra. So we got hung up at the 52.92 cog line, the ADR half to the upside. When we hit one side really early, it opens up the door for us to hit the other side by the end of the day. There is also the concept that if we hit that level and we don't drive away from it to the other side, and instead we come back and test it, it's very likely going to break. We've seen that time and again where we get to the level, we don't drive away from it to the other side, and instead we come back and test it, it's very likely going to break. We've seen that time and again where we get to the level, we don't drive away from it to the other side, and instead we come back and test it, it's very likely going to break. and we fight against it for a while, leave the zone, and then come back to it. Which is different than, say, yesterday, where we got to it and we just left it for a little while and came back and broke through it. We got there and we just kept fighting it. Now that we've left and we've come back to it, we could break through it and continue to the upside without ever having hit this other side at all. So our Globex low is our line in the sand, 52.32 hog line, which is the put wall, the halfback, the cog line, everything, right? It's all three of those just stacked up support, and it's our Globex low. So it really needs to hold. Looking at the volume profile for the week, that's also where the current point of control is. So it's where the greatest amount of volume is at. This is a voodoo line. I believe they call it forest. It's green. So some unimaginative people call the white one snow. Anyway, it's a pretty solid level. One more reason to say we need to hold this line. Now that we've tested it, we got back above it, it really needs to stick. This was a really nice recovery bar, kind of one of those examples that I was talking about yesterday. It didn't recover as much as some of the better examples, those ones where we really head to the downside, rally back up, break through our own open, and get an equal distance to the upside that we had on the downside before the day is done. It wasn't that good, but that was still a really nice recovery bar. My concern is that it wasn't that good. So there is the concept of pure price method without even applying any moving averages or indicators, just looking at what price has been doing. This is a classic trend example. Lower high, two lower lows. Now that can be argued if this is just a higher low, then this is our first lower low. This is now going to be our second lower low, but it's still two lower highs and two lower lows. That's a full set, and a full set is a trend. Also, looking at the way the market broke this low, it's taking that low and that low, even if it is a higher low. Market used it anyways. Then there's the distance of the pullback. We were looking for 5 to 7. We ended up with 8.5. 10.5 by the time it was done. If we had closed down there, then it would have been a 10% pullback off of the highs. That would be, quote, correction territory. It isn't necessarily how far we went, it's how fast we went. Rate of change is a really big deal. It's one of the oldest metrics in the market. So this low has to keep. Just like the low back here needed to keep, or we were going to get a significant breakdown, which we got because it didn't keep. This one now needs to hold. Part of that work is just snapping a fib. 52.32 cog line. is the halfback. So that really needs to stick. For the upside, we've got a lot of work to do. It certainly won't be easy making our way back up. We got some gaps to fill along the way, including this gap between Friday and Sunday night. We can see that there's an option level down here, 51.27. This is just some of those extra levels that Spot Gamma has. They're usually something like L1, L2s. But if you read through their notes, a lot of times it's just cumulative levels. So there'll be a spot where there's just a lot of open interest and they'll mark it out as a potential area, but it's not an official put support or anything like that. So we do have a level down there. And we tested that area already yesterday. So got a little bit of history at this point. Since all of the moving averages are over our head, it just adds to how much resistance there is to work through above. And I don't see how we're going to get through that resistance without some catalyst that moves us up there. We don't have the aggressive investors and firms and funds piling money into the market to drive us through there. We need that warm, fuzzy feeling and at least some fear or greed, right? We don't normally think of fear for the upside move. We tend to think of greed for that. So we need to light up some animal spirits or something, but just without an earnings, we got NVIDIA coming, right? There's that, but without something, what's the fuel to get money flowing back into those Mag 7s and up through this zone? We're still underneath the volatility trigger and the zero gamma, depending on who you listen to. We're not in negative gamma. I don't know. It's kind of ties in with where you're getting your data, right? And how far out you're looking. As far as I'm concerned, we're still in negative gamma. And we're just going to stick with that. Yeah, I did. I was going to share it yesterday, and I forgot to share it. This is the updated volatility futures watch list. You can build it out, but I can also just share the link. It has the 3-month, 6-month, 3-month, 1-month. So if you don't have, VIX futures, you can just look at those three. If you have the futures from August to December, we can see 27, 26, 25, 22, and then 21. It's not supposed to be climbing down as we go out in time. It's supposed to be climbing up. So we're still in backwardation. When we see this flipped around and 21's at the top and 27's at the bottom, then we'll be in contango. And contango is meaning we're back to normal. So we're not back to normal yet. We are building up some volume here, but considering how little time we spent at this 53.50 area and how much volume we got, versus how much time we've spent down here at this 52.25 area. We've spent a lot more time down here and we have less to show for it. Maybe because it's more distributed. If you think about how narrow this high volume node is, it was really concentrated into a very narrow specific zone, as opposed to this one down here, it's wider. So maybe we could attribute it to that. Either way, it still makes 53.50 a significant level of resistance that we're going to have to fight to get through. And it's where the point of control is very likely going to end up unless we continue to stay in this zone and build this volume out more. But if it stays this distributed, then it's going to be really hard to beat that one before we run out of time. So at the moment, 53.50 is looking like the next point of control, and it would be better if we can get above 53.50 before it becomes the next point of control. That way we can launch off of it rather than fight our way through it. We have a new VPOC from yesterday. $52.05 is the point of control from yesterday. It hasn't been hit, so it's VPOC. We've got a number of them stacked overhead. This is the first one we have underneath this. It's a good start. We need to see this flipped around where we have more underneath us and less above us. The only way to do that is just to work through them. Friday's concentrated level, that 53.50 area, it's just going to be really hard to get through. We are back inside the weekly expected move. We tend to close inside that box 80% of the time on the S&P. But since it's a 1 standard deviation measure, we only need to close inside the box 70% of the time to do what a 1 standard deviation says we should. So the expectation is that we can stay in the box, but in a high volatility market conditions, markets generally exceed their expected moves. Our distance from the 10 is from the 10-day, 2.86%. That's the deepest it's been through all of 2023 and 2024. We haven't been that far away from the 10 since August 2022 in that bear market. That was after Powell did that mic drop Jackson Hole moment when he told the markets to just suck it up and take it and walked off the stage. It's after we hit the 200 period moving average and everybody was looking at that. You know, it's like the classic head and shoulders 200 period rejection and then the mic drop moment, and the markets just had a conniption fit and dumped into the extremes. That's the last time we were this far away from the 10. So, you know, it's kind of the same backdrop. Markets were overreacting. Everybody's scrambling for the exit. And the same results too, an immediate rebound back in the other direction. But that doesn't equal, you know, rallies back to old highs and that sort of thing. It's just a rebound because it overshot its landing completely. So we're looking to get a lot closer to the 10-day, very likely underneath this -2. So maybe 1.5 to 1%. Still on the bottom side though. I don't think we're ready to go test the 10 yet. And we're 3% away from the 10-week to the downside. We've been farther away from the 10 than this in the last 2 years. This this low in October 2023, that was the central bank coordinated intervention with Japan. They kind of flipped everything around, and QRA, and just, it was like fire hose of liquidity. So last time we were this far, right? I would look for an average on how far away we are from the 10-week to the downside. But generally, when we get this negative, we tend to really get negative. I mean, there's been some times where it was just a quick dip and we were back up again. But we kind of passed the level where we would expect a quick dip and then back again. Maybe, right? Like back here in March 2023. Maybe we're just going to dip down and come right back out. But, you know, a lot of times if we get this deep, it turns into a little something extra. This is where the concern starts to come in. I know it looks like a lot. We got a lot of stuff on the screen here, but just one chart at a time and you won't get overwhelmed. The top 3 are the risk on. The bottom 3 are risk off or defensive. And the middle 3 are the midline. All these are sectors. When the Mag 7 was doing good, technology, consumer discretionary, financials, those were the 3 on the top were doing good. That was most of this year. The idea was, okay, those have stalled out. It's a crowded trade. Everybody's getting nervous. People are taking profit. And we were looking for a rotation into the defensives. So these ones on the bottom. And that made sense. We were looking at this yesterday. These were green over a 5-day period. They had been working up well. They're near their highs. They're doing good. Except now they're not. This is a 5-day change label. So 1 day's move wiped out 5 days of profit and put them in a negative space, except for utilities. They had a big move down, but they had an even bigger move up, so they're still slightly positive. This isn't the rotation we were looking for. Now, sure, the Mag 7, like tech, that's a red candle, but it's a hollow red candle. Hollow red means it closed higher than it opened, but it closed lower than the previous day's close. So it did close up from where it opened. It rallied. Same thing with consumer discretionary. Sure, it closed lower than the previous day's close, but it rallied and then it closed. So money was flowing into that a little bit, and it was flowing out of these defensives. What we want to make sure we don't get is across the board selling. Instead of rotating out of the Mag 7 and into defense, what we don't want to see is rotating out of the Mag 7 and also not holding on to the defensives. If they're selling everything, that's a bear market. Now, 1 day is nothing, and tech was down a lot, so it kind of needed to rebound anyways. But on the other hand, these defensives were mostly still within their boundaries. They weren't overextended, right? Except for maybe utilities, but certainly not healthcare. It's been holding this range. And the same thing with staples. It's been holding the range. So it wasn't like it was some overbought, overextended, due for a pullback sort of market environment. No real reason for these things to have been sold off yesterday, other than a rotation back into the high flyers. The concern is, what if it wasn't a rotation back into the high flyers? That it was just a rotation out of defense. TLT still pulling back from that 100 mark, slow and steady. We don't want to see it, crash and burn away from that level anyways. We want just a nice slow descent away from that 100. Nice and easy. The SPX should open above that put wall because the ES is rallied. The S&P, the SPX will open above this level, should, unless we fade back down in the ES before the open. So 5,200 should act as that support too, since it's the put wall. It needs to hold as a support. And we still don't have the AM yet. NVIDIA is leading the way. Broadcom, Tesla, Qualcomm, Intel, PayPal, Meta, and Netflix. It's all the high flyers. It's a Mag 7. Now, granted, that's basically what my list is, but I do have some staples on there. Apple on the other side of things, down a little bit, but it had a pretty nice rebound anyways. So we'll start with what's down. Bonds are down. And really that's it. The China ADRs are down a little bit. They're not down enough. They still need to drop another 0.25%. And nat gas is down. Looking at what's up. What's up? Cloud computing, communications, gold, biotech, financials, energy, banks, airlines, semiconductors. It's not overly encouraging though. They moved so far, so fast to the downside that a little bit of mean reversion makes sense. It doesn't necessarily make us, aggressive, bullish. Bitcoin's up, but it couldn't even maintain this breakout. So it did get an inside day breakout. It got outside of yesterday's levels, but it already gave it back. Semiconductors hasn't even managed to get out of the box yet, or maybe it wicked out, but it certainly didn't expand above it. It's likely that we'll come back to the anchored VWAP if we can hold the line, say 50% of the last big bar yesterday, that rally bar. Pot stocks are up, but they're still underneath the halfback. Even this sharp decline didn't give it enough juice to even get a dead cat bounce of note. Tech stalled. Looks like everything is inside day at this point. Caterpillar had a good earnings. That could be part of why industrials is up this morning. It's probably not enough. And it's already given back. It made it back to the anchored VWAP, 333. Sales are down, rentals are down. They made money. Their forward outlook is good at the same time that they're saying things are slowing down. It was enough for people to get excited, I guess. So it's a pretty simple lineup today. Most of the market has a really big bar from yesterday. You can start out with things that are above their halfback on that really big bar, or things that are below their halfback on that really big bar. Anything that's going to make a move to the upside has to get through that halfback. So if it is underneath it and it crosses through the halfback, you can make a run for the open and then the high of the previous day. And it doesn't really matter which one of the equities it is that you're looking at for that, right? Take your pick. Anything that's underneath that halfback, that'll be the play. Get through the halfback. That's a trigger along to the open and then to the high. And if there's anything left, you can try for an overshoot into the 111. If we're going to open above the halfback, it needs to keep it. Any break below the halfback would be a short to the close and then to the low with an overshoot into a 111 on the downside. If we're already an inside day breakout or we're near the high of yesterday on anything, then we got to get the breakout. We got to get through liquidity at the 111. Then we can aim for 50% to the upside. So you just measure the whole candle of yesterday, plot 50% higher and then 100% higher. That'll work on everything in the list, right? They all have the same setup. It'll be one of those three. And if it's underneath yesterday's really big candle, then any rally has to get back inside that candle first, and the target will be the halfback. If it fails and falls back out, or it fails to even get back in the box, then it's a continued short with levels to the downside at 50% and 100% of the candle. Simple, simple, right? So I got for you guys, be careful, be safe, watch the clock. I'll see y'all tomorrow.